Ladies and gentlemen, a very warm welcome to the ISAS-SICCI panel discussion on the India budget for year 2026, prospects and challenges. We at SICCI are delighted to have you with us today for what promises to be an insightful and engaging discussion on the implications of the recently announced budget for India's economy and businesses. This panel discussion will provide expert analysis on how these fiscal policies will shape growth, trade, investments, and help businesses flourish in the coming year. Without further ado, let's begin with the introductions and overview of today's session. Our session today will be chaired by Dr. Amit Palik, Senior Research Fellow and Research Lead at the Institute of South Asian Studies, National University of Singapore. Dr. Palik has a wealth of experience in international trade, investment policies, and the Indian economy. He has served in multiple prestigious roles, including with India's Ministry of Finance and Industry. We are privileged to have him lead this important discussion today. We are also joined by three esteemed panelists today. Mr. Viksit Bharat, Director at Inbrew Asia and Inbrew Holdings and Board Director at the Singapore Indian Chamber of Commerce and Industry. Mr. Vivek brings with him extensive experience in corporate finance strategic management across Asia, with a focus on the beverage sector. Ms. Priyanka Kishore, the founder and principal economist at Asia Decoded Singapore. Ms. Priyanka has over 2 decades of experience in macroeconomic research and has a deep understanding of long-term economic trends and trade impacts in Asia. Lastly but not the least, Mr. Vinod Rai, Distinguished Visiting Research Fellow at the Institute of South Asian Studies, NUS, and former Comptroller and Auditor General of India. Mr. Vinod insights into financial oversight and public sector reforms will provide a unique perspective on the budget's fiscal policies. Without further delay, I'd like to pass the floor over to Dr. Amit Palik, our chairperson, who will guide us through the conversation. Dr. Palik, over to you.
Thank you so much, and on behalf of ISAS, I'd like to welcome all of you to today's budget program. One of the first occasions when we are working with the Singapore Chamber of Commerce and Industry. Thank you, Vivek. Thank you, colleagues from SICCI. We are here to discuss the first full budget of Modi 3.0 because the last budget that was presented was after the election of the Modi government for the 3rd time, and that wasn't a full budget in the sense that wasn't a full year budget, that wasn't for the full period of 12 months of the fiscal or financial year. This is where we are looking at the first full budget, and this budget actually comes in the context of a very interesting background, both globally, regionally, as well as domestically. Globally, this is the year when, after a period of 2 or 3 years following the COVID-19 pandemic, there are more or less certain expectations of the global economy, if not slowing down, then kind of settling into an equilibrium, which will not see a very robust rate of growth. And within that space, if one looks at the major economies of the world which has been contributing to the overall growth momentum, India clearly was very much high up there. It might continue to be well up there, but by India's own GDP growth estimates for the last 2 years, this particular year, the FY2025 is expected to have a lower rate of growth. And this is at around 6.4%, which I think will be a very sharp reduction compared with around roughly 8 percentage points that it was expecting. Moving on from there, there are certain other issues which are clearly complicating the global economy landscape. One of them is the continuation of a large number of transformation and transitional challenges. Most major economies of the world are trying very hard to maintain an investment momentum in their domestic economies. The pressure continues to remain more on the governments to supply the investment, but there is not corresponding response that is being witnessed from the private sector. Private investments are not as much as one would have liked them to be. So there is some concern over there, and that is a concern which probably resonates with the Indian economy as well, that for the last 2 to 2.5 years there's been very high public sector led growth through investments, but the private sector investments probably has not responded by the amount by which they were expected to. There is widespread concern over the global state of prices. And prices are something which are showing a tendency to become sticky when it comes to basic commodity prices, basic services prices, and even when one moves further up into a large amount of items, specifically on individual consumption and household baskets, there's not much by way of relief that households and people have received over the last 1 to 2 years. This matters much for an economy like India, and though there is an expectation that inflation will somehow settle down maybe in the 4 to 4.5% range, whether that will be achieved or not is a different question, and I'm sure the panelists will have their own views to offer on that. In India's case specifically, there have been 4 major factors which guided the construction of this budget, and they can be taken as a combination of factors which should be influencing economic growth both from the supply side as well as the demand side. So, for example, from the supply side, we have both agriculture and industry as the focus areas of this particular budget. On the other side, we have small enterprises, the micro, small and medium enterprises as one important factor which should be driving the rate of growth of the economy. And then we also have exports. And in fact, exports are one sector where we see a lot of attention in this budget compared with most other budgets. And there are reasons why perhaps the exports have been singled out for more specific attention this year. We are also, I think, and this will come back again as a recurring theme, I'm very sure given the way things are, we are aware of the Trump 2.0 having begun in the United States and the kind of disruptions it has begun creating. There wasn't an expectation that the US aid will be frozen, but that in one respect will also have certain implications, and particularly when we look at the sort of portfolios, the funding portfolios of a large number of enterprises, not just in India, specifically in India, but even in other parts of the world, including in Southeast Asia, there will probably be some impact, and we'll need to wait and watch for that. But I think what we look at in the greater context of this particular budget that, as we call it, as I mentioned in the beginning, the first full-term budget of Modi 3.0, is there is an effort to reach out to certain kinds of constituencies which would make a decisive impact on the economic growth of India through higher consumption. That's kind of the salient point that I think we can see in this budget. So there have been these very, I would say, prominent announcements over income tax relief, which has come in the budget. There are customs duty reductions which should be of significant help to exporters. There are also a lot of efforts that have been devoted to increasing investments and supporting infrastructure growth. There is specific attention that has been devoted to improving the conditions of MSMEs. So I think at the end of the day, on paper, this looks like a budget whose main objective has been to address the point that after 2 or 3 years, the Indian economy is going to have a rate of growth which is lower than what it had got used to in the immediate aftermath of the COVID-19 and rebound from it. So, interesting things to look into in terms of how the government is going to continue its fiscal disciplinary path maintain the outlays on various public welfare programs that it has, in spite of deciding to forego a substantial chunk of revenue through the income taxes and other methods. All taken together, this is an interesting exercise that we will see. And we have a very competent and distinguished group of people to address the budget thread on various sides. So what I'll do is that we are going to follow this format where I'll request all the three panelists to speak for around 12 to 15 minutes in their opening sort of context and understanding of the budget. We are beginning with an unexpected bang in the background. So I'm sure we will look forward to more such unexpected capturing of insights as we go ahead. And then we will come back for a Q&A. And please feel free to step in with your questions, comments at any stage. So with that, let me begin by inviting Priyanka Kishore, the founder and principal economist of Asiatic Cooperative. Priyanka, over to you.
Thank you, Nandhu. Good afternoon, everyone. As Nandhu has already highlighted, there's a global backdrop probably to how this budget was thought about and constructed. So let me start by talking a bit about the global economy and a positive observation that I think has not got as much attention as it probably warranted. Contrary to the widespread expectations that we've had for late 2023 to most of 2024, the global economy actually did quite well last year. If you were looking at IMF, International Monetary Fund's projections in October of 2023, they expected US growth to be half in 2024 of what it was in 2023, just 1.5%. Most of 2024 was spent by analysts speculating when will the US dip into recession. Today we know that the US grew almost at a similar pace in 2024 as 2023. And this is not just limited to the US. Even here in Asia, growth in China, India, Malaysia, Singapore and Taiwan all notably outperformed in 2024 their initial growth forecasts. Now, what drove this? This reflects two factors, and these factors are perhaps not that supportive of growth this year. The first one, of course, a buoyant US economy and a strong tech cycle that supported global demand and Asian exports in the face of a China slowdown. Second, a resilient regional domestic demand. Now, of course, in Asia, it's never one macro playbook for all. But if we take a top-down view, we can identify tight labor markets, rising real incomes, especially here in Singapore, infrastructure investments in India and Indonesia, for example, and supportive policies. All these came together to keep local demand, resilient, not falling a cliff, and that is a good growth outcome for the region. Unfortunately, in 2025, both factors are vulnerable to the Trump administration's policies that are fueling trade and policy uncertainty globally and have raised downside risks to growth. I think you mentioned about India's growth slowdown. The projections even for the coming fiscal, it's a very wide range. The economic survey really talks about 6.3 to 6.8. So we'll see how it ends up, but really the odds are against the region at this point of time. For Asia, no marks for guessing. The top concerns, tariffs, we've already seen in the first few days of Trump presidency. China has already been hit, it has retaliated, but we are nowhere really close to what was campaigned on. 60% tariffs on China, 10 to 20% on every other trading partner. So we still need to see how this pans out. If you're looking at what they are looking at, it's anybody's guess. From a bilateral trade perspective, I don't think any country sort of escapes other than Singapore, which is the only one which runs a trade deficit with the US. But even in Singapore, if they decided to look at sector-wise trade surpluses, so the pharmaceutical sector for Singapore, for example, it ran a 9 billion trade surplus with the US in 2023. So you don't know what they're going to look at, how they're going to come at you. Singapore's position as a major re-exporter also could put it in the firing line, as we saw with the NVIDIA chips episode. One could say that it has a FTA with the US, the only other Asian economy other than South Korea, which actually has a free trade agreement with the US government. But we know that President Trump has stamped regard for these kind of documents. He's already announced tariffs on Canada and Mexico. Delayed them a bit, but they're coming. In 2017, the FTA with South Korea was pretty much renegotiated to enshrine tariffs on trucks within that document. So any FTA could be renegotiated, and to that extent, I would say it just shields Singapore maybe from the more damaging tariffs. It does not take it out of the firing line. So who is most at risk? We all know China is the largest, has the highest trade surplus with the US in the region, and is also the largest source of US trade deficit globally. Now, China was hit before, during the first Trump administration, and it survived. But the point here is that the proposed tariffs under this administration, if they were to materialize, they're bigger in scope and they're bigger in scale from the 7.5 to 25% range of tariffs that were announced in 2018-19. And to that extent, in a worst case scenario, could actually knock off up to 1 percentage point of China's growth from this year to next year. So China will split from 2024 growth rate of 5% to 4% in 2025. There's a big downside risk there. And more so because, one of the things that they did use in the past was that they used connector economies, so to say, Vietnam, Mexico, to route, even parts of Southeast Asia, other parts of Southeast Asia, to route their goods to the US, and they're going to come down hard on that. Origin of goods is going to be scrutinized quite a bit. It does not help from Beijing's perspective that this potential scrutiny on exports is coming at a time when it is already grappling with its own domestic challenges, right? There's a property downturn, there's a consumption slump, and any hit to exports would translate into lower incomes, unemployment in those industries, and that could potentially worsen the downturn. So not looking good for China, and outside of China, the tariff imposition risks are highest for, I would say, Vietnam, Japan, South Korea. All of them have excess of 40 billion of trade surplus with the US. And Vietnam, along with Singapore and Taiwan, is also the most exposed to a Chinese slowdown in terms of how much they contribute to China's domestic economy. So that's the regional overview. And let me come to India, which is the focus of today's panel. Now, the good news is that India is less exposed than most of its eastern neighbors to trade and China's slowdown risks. Consumption accounts for nearly 60% of India's growth, so it's pretty domestic demand led. But as also mentioned earlier, it has been contending with the domestic demand slump. And so at least post-pandemic, in recent years, exports have become very important, both as a source of demand as well as a generator of jobs. We're seeing new jobs being created in the electronics industry, which is pretty much powered by exports at this point of time. More so, it is the US who is powering this export growth because it is the key destination, the largest destination for India's electronic exports. So in this environment, if you are hit by tariffs, it is going to matter, and it will matter more or less depending upon which industry is hit by tariffs. For example, if labor-intensive industries like gems and jewelry or textiles, they are hit, the knock-on impact on the domestic demand is going to be more in that regard. The other thing is that we all know that PM Modi is meeting President Trump this week, and unfortunately his trip comes at a time when there's increased rhetoric on reciprocal tariffs. India is the worst offender in this regard. India's average tariffs on US imports is 9.5%. The US only charges about 3% on Indian goods going into the US. So this is something that's definitely going to probably come up in their talks. And I would think that Finance Minister Sitaraman had these thoughts at the back of her mind as she crafted and delivered the FY2026 budget. There was already talked about the income tax cut that's supposed to lift middle class income and support urban consumption. In addition, the budget also had a host of custom duty cuts. You must have read, part of it is targeted at forestalling the US tariff threat by making US imports cheaper, but also support for domestic industries coming through, especially the electric vehicle industry. So a lot of reductions out there. But the tricky part is that even as they have announced these income tax and custom duty cuts, they also intend to stay on the path of fiscal discipline. So the fiscal deficit is projected to narrow by another 0.4 percentage point to 4.4% of GDP next year. Now, this is where I would say that the budget math, it gets a bit troubling, because we've already discussed risk to growth are on the downside, and typically when growth slows, tax collection is slow, direct tax collection is slow. On the top of that, you also have an income tax cut, and you also have custom duty cuts. And the proposed consolidation is baking in an increase, a marginal increase, but an increase in tax receipts to compensate for this narrowing of the deficit so that expenditure does not take too big a hit. I would say, given that the government itself is estimating about a 1 trillion INR loss in foreign revenues from tax cuts, this is a bit optimistic. It looks a bit optimistic to say that they will do the tax cut and deliver the consolidation. So the question then that stares us in the face is what will give? Will it be fiscal slippage, which means that your actual deficit turns out to be higher than what you're targeting, or you will compress expenditure even more? So on the deficit side, I'm sure everybody has their views. My view is that this fiscal credibility is very hardened by this government. Even as India has grappled with various growth challenges post-pandemic, they have not strayed from this path and have delivered an impressive 4.8 percentage point of consolidation since the pandemic. This is not something they would like to squander away and push away the borrowing cost. It does come with a cost as well, right? You cannot just have a higher fiscal deficit. So if that stays, then the trade-off is between revenue expenditure and capex expenditure. On the revenue side, there is really very little scope for them to even spend less without completely crimping essential expenditure on education and health. To give an idea, anyway, health expenditure is just about 1.9% of total expenditure, education 2.5%. These ratios are barely moved in the last few years. So I don't think they can do that, and that naturally makes the capex a scapegoat. And this is what they have done for the last 3 years to stay on the path of fiscal consolidation. Typically, the capex target has been missed. And this brings us to the question that will tax cuts actually help growth? I would say from an economic perspective, where we look at the multiplier impacts of such decisions on the economy as to how many times can it stimulate growth, the effects of tax cuts probably might be overwhelmed if capex targets are not met. And you already have a narrowing fiscal deficit, which means the overall government is spending less. And if that spending less happens more on the infrastructure side, then the budget overall may not be stimulatory for growth. That essentially then puts the ball in the central bank's court, the RBI, and we already saw that they responded with the the rate cut. Too many cuts. They have already responded with the rate cut. And I know that the new governor, Mr. Malhotra, has struck a cautious note. But in my view, even with inflation between 4 to 5% for India, if it stays in that range for this fiscal year, the central bank will deliver sizable cuts. It could be in the range of 100 to 150 basis point cut cumulatively. That is my view. Now, of course, immediately the question I get asked is what happens to the rupee then? Especially because the Fed is increasingly supposed to not cut, or maybe just cut another 25 to 50 basis point. Yes, there would be depreciation pressure on the rupee. It's already down 1% against the US dollar in just the first 2 months of the year. But we've seen the RBI came to intervene recently to limit the pace of depreciation. Given that the US administration would also keep an eye on the currency from a manipulator list, RBI will not let it go into a free fall. So I would say 2 to 3% managed depreciation for the full year would be my base case. So not taking too much more of your time, just to say that I have talked about the downside risks to the economic outlook in 2025, but it would be amiss to not mention the services trade advantage that India does have. And given the fixation that Trump administration has with goods trade, managing goods trade and the deficit, and also controlling migration, skilled migration and things like issues like that, services trade actually goes pretty unnoticed. So that means the GCC-led services trade expansion that India is experiencing will continue, and it should help mitigate the downside pressures on growth. The other thing is that the budget did announce a host of industry-specific measures that Vivek will talk about in much more detail. By facilitating production, that could also help manage the downside risk to growth. So my conclusion will be that with adequate policy support and resilient private sector, India can escape a very big hit to growth in 2025.
Thank you, Priyanka, and thank you particularly for the excellent budgeting, exactly 15 minutes. So,
I was looking at it.
Thank you. Vivek, over to you. Vivek is a familiar face here, so he doesn't need an introduction. But please, go ahead.
So I'm going to use a presentation. It's very simple, but just because the budget is so huge that we need to put it all down together. So I'm going to focus, as Amit and Priyanka mentioned, on what are the key changes that affect the industry, businesses. But I'm going to start with a fun fact. Have I gone too far? Sean, I need your help, sorry. There's a problem of being in the wrong generation of technology. Okay, let me go quickly to my appendix, because I think the budget is far overridden by the Trump tariff, especially the reciprocal tariff, right? So I want to show you some interesting statistics on this space. Now, I think Priyanka mentioned that India has 9.5% weighted average tariff on US goods. US is 3%. Now, this 9.5% really stands out against all the ASEAN countries. It's the highest. Even higher than China, Thailand, and everyone else. And US is generally around 3%, more or less. Some are lower, some are higher. So India has the highest amount of tax, import tariff against US businesses, against US products imported from the US. And India also runs a trade surplus. We know that overall India has a current account trade deficit, but against the US, oops, sorry for my senior moment. Okay, yeah. So what does this reciprocal tariffs mean for us? India has about, as I mentioned, about 38 billion of trade surplus with the US. Some say it's 45 billion. And India has tariff on agricultural stuff that comes from there, which is natural protection, protecting Indian agriculture. But a lot of other areas. Now the way it works, reciprocal tariff means if India is charging import duty on cars from US, the US will do the same. They'll charge export duty or import duty for cars imported from there. But I think for India, US is its largest export destination. So 38 to 40 billion is roughly 1% of GDP. So if you have to work that out, there's a fair amount of impact on the industry. And if there are import duties on Indian products exported to the US, that will impact Indian businesses a lot. And you've seen that in the stock market, it's down 3% this week. So the rupee is also weakened. It went to 87, now it's about 86.5. So I think this is a bigger issue for us than the budget. And we hope that Modi ji does his trick in the US. He'll have to buy a lot more military stuff, a lot of oil.
Yes.
So hopefully that sorts it out. So now that's the end of the fun fact. Sorry, it's not a fun fact, it's a challenging fact. But let's go on to the budget. Sorry, this is the last time I'm going to do this. Yeah. So I think if you look at the key highlights of the budget, sorry, some of you cannot see me because I'm blocking it, but there are 4 or 5 key pillars of this budget. One is obviously the focus on boosting consumption, which is through the income tax reduction that has been done at the bottom layer. Medium and small scale enterprises, micro, small and medium enterprises, they have been given a lot of benefit, and as I'll show you very soon, they are very important. Infrastructure has got a lot of boost.
Let's go back a few steps also.
Yeah, thanks. Manufacturing, exports, agriculture, and on the softer aspects, something that comes out very much in the budget is they're simplifying the taxation and also trying to improve the ease of doing business. So I'll touch briefly on all these things. Let's go quickly. So I think the one factor that has been covered the most in this budget is a reduction in the income tax for the lower end of the society. So essentially the rebates have been increased from 25,000 to 60,000, which means that the earlier 700,000 income was exempt from tax, now 1.2 million will be exempt, which roughly benefits about $1,000 or 100,000 rupees for each individual in that tax bracket. It will take out a large chunk of the tax base. India has a very low tax base, 80 million out of 1.4 billion, so about 5%, 6% of the people pay tax. Out of this, I've read that at least 10 million or more are in that small bracket, on the lower end of the bracket, which will vanish. But it will give 2 benefits. The middle class is affected by inflation, and consumption is really struggling in India. If you look at the top 20 consumer companies, FMCG companies in India, everybody is growing at single digit, low to mid single digit, including price increase. So volume is even lower. So there's a big struggle happening, so this will work quite well. And this will be a boost for consumer companies, auto companies, housing sector, which is also struggling a bit with low growth. So, and you immediately saw the impact on the budget. Companies like Hindustan Lever, Nestle, Dabur jumped 4%. Auto companies also went up. Real estate companies jumped. Infra companies actually went down because they reduced the spending from 11 lakh crores to 10 lakh crores, right? Which is, yeah, so I think this is a boost for consumption, which is probably the single most important part of the budget. The second thing is MSMEs. Now, the MSMEs are a very important segment for the Indian industry because there are 63 million of them, only 10 million are registered. They employ 75 million people, which is second highest after agriculture. They contribute 35% of manufacturing and 45% of exports. So it's very important. The biggest thing that has been done is that they have doubled or increased the limit for MSME by 2.5 times. Now this is important for us because a lot of us set up not very large businesses in India, and there are a lot of benefits for MSMEs in India. So you may want to see where you fit in and see if you can avail of the benefits. So this is a lot of numbers here, but essentially from an investment point of view, a micro enterprise, there was a limit of 10 million rupees, now it's increased to 25 million rupees, which is $500,000. Small enterprise has been increased to 250 million, which is roughly $4 million, Sing dollars. Medium enterprises, which is where I think a lot of us may fit in, the limit for investment has been increased from 500 million to 1.25 billion, which is about $20 million. So if you are investing up to $20 million in India, you get a lot of benefits under the MSME rules. And I think Singapore restricts the benefits for MSME to Singapore owned, at least majority Singapore owned. India does not have that restriction. So in India, foreign owned MSMEs can also get these benefits. You want to check this with your advisor, but this is the information I've got from Invest India as well. In terms of turnover, at the high end, it was 2.5 billion. Now that has been doubled to 5 billion. That's the limit for being for a medium enterprise. That's $80 million. That's a lot of. So we have a lot of leeway in terms of this for investing in India. So what are the changes they have done? They're doubling the micro and small credit to 10 crores. There's customized credit cards with 5 lakhs, which is about $8,000 Sing dollars. Limit for micro enterprises. They're going to give a loan of up to 20 million to 500,000 first-time entrepreneurs. And this is a big credit push for MSMEs, 1.5 trillion rupees, which is 25 billion of credit will be given to them. So the MSMEs who typically struggle to get banking facilities will stand to benefit a lot from this. And retailers will benefit a lot because they can stock up more and expand the reach. Now, what are the benefits to MSME? This might be useful for some of us. Now, some of these are past benefits, some of them are current. You may want to check because these benefits keep changing. But there's a tax benefit exemption of up to 7 years. A lot of sectors like mineral oil, gas, fertilizers have got complete tax holidays. MSMEs pay lower tax, 25% versus 30% for domestic companies. Also, the minimum tax is lower at 15%. They have simplified the GST registration. There's a lot of focus on making loans cheaper and easier for the MSMEs. There is a reduced rate of interest. You get subsidy on patents. There's an industrial promotion subsidy for new investments made in plant and machinery. There's a rule in India that if a company does not pay a MSME within 45 days, it's a criminal case, I think. They have to pay within 45 days. So that helps the cash flow for a lot of small companies. They have free certification. They get a lot of subsidies, which Singapore also does if you travel overseas on business missions. And there's a requirement that all the central public sector enterprises have to buy 25% of their products from MSMEs. And this is without a global tender, without a local tender. There's also toys, which is small scale, has got a lot of incentives. This is my usual warning. Please consult your advisor for the latest news. The next big thing is infrastructure. I think as Priyanka mentioned, the spending was in India, 11 is an auspicious number. So they had planned to spend 11.11 trillion rupees or 175 billion Singapore dollars on infrastructure. That has been reduced to 10 trillion because of the deficit. So if you know the stats, the original budgeted deficit was supposed to be 4.9%. We'll end up at 4.8%. So 0.1% lower than original budget. On 4 trillion, 0.1% is 40 billion. That is roughly part of the difference comes from it. 4 billion is 1.1% of 4 trillion economy. And that has been met essentially by reducing the investment in infrastructure. Some of the significant reductions on loan to power project has gone down quite significantly from 1 billion to 750. Water supply, sanitation down from 11 billion to 400 million. So that's a huge reduction. But on the positive side, on the long term, the government is committed to infrastructure. The next year budget, they have increased back the spending to 11.2 trillion. That's 3%, 3.1% of GDP. All the infrastructure ministries have been asked to come up with the public-private partnership projects. $25 billion as interest-free loan will be given to the states for infrastructure. There's a plan over 5 years to raise 160 billion for reinvesting in infra projects. There's also another 16 billion. So essentially, there's a lot of provisions made in the budget for infrastructure. So longer term, infrastructure remains critical, and infrastructure is what has been driving the growth. And the multiplier effect of infrastructure is 3 to 1 to the economy. You spend $1, it has a $3 impact on the economy. So it's critical for job growth. So I think there's a lot of benefits given to private sector, health, nuclear energy. They have discovered the small modular reactors which are less risky, where $3 billion has been put in. There's a blended finance of 25 billion for 100,000 affordable houses, and there's a lot of money on AI as well. So I'm now going to the specific industries. I know this is a lot of stuff, so you may get a bit bored, but I'll quickly run through it. Footwear, leather, and toys. Electronics, as Priyanka mentioned, duty-free imports of components for another 10 years. Electronics, this is a good one. If you bring technology into India, or you bring services into India for electronics manufacturing, there used to be a heavy amount of tax on those services. Now they've reduced it to only 25% of the service value. So even if you take 40% tax, it's only maximum 10% tax you pay on the amount. GCCs, as we spoke about, India is the outsourcing capital of the world. And now they're encouraging to go into emerging tier 2 cities. Where tier 1 cities are completely maxed out in infrastructure. You go to Bangalore, it's a global hub for outsourcing, but you can't go from one locality to the other without being stuck in a traffic jam. So I think that tier 2 cities is a good one. Customs duty exemption on all these modern economies, the EVs and the mobile phones. Shipbuilding, shipbreaking have been given customs duty exemption. FDI on insurance has been increased to 100%. And for shipping, they have given some benefits to local domestic vessels as well. Again, for energy, as I mentioned, there are 3 billion for nuclear energy. The government plans to spend set up 100 gigawatts of nuclear power. Tourism has been given a lot of benefits. So you get visa-free access. There is, any of you are in the airport space, there's 120 new airports being set up where 100% FDI is allowed. Tourist destinations and medical tourism also being boosted. Then, as I mentioned earlier, 3 billion for private sector, and for startups there's another 10,000 crores which has been working. Exports is going to get a new export promotion mission. They're going to have a new unified digital platform which will make trade documentation easier. They're going to put up air cargo facilities, especially for perishable items, so cold storage will be arranged. And this is something which was a big issue for companies from overseas. If they were making purchases in India for export, that company was deemed to be a local establishment, so they had to pay tax on that, but that has been removed. Agri, I don't think I want to go too much into this. I don't think there are many farmers here. But the main is the mission for our self-reliance on pulses. So they want to make pulses as self-dependent, as self-reliant, and a lot of incentives for farmers. So we can skip this quickly. Yeah, I think so. That was on the industry side, a quick run through. On the softer parts, on tax reform, they've simplified tax reduction at source. They've, as I said, removed some customs duty. Transfer pricing is a big issue. A lot of audits are happening there. It happens year by year. Now companies have been given an option to do a block period of 3 years. So if you get an assessment for your transfer pricing, you have the option to say, let this stick for 3 years instead of having to do it every year. So that will reduce compliance. The tax officers have been given fixed time limit to finalize. They can't keep the assessment pending forever. I mentioned about 25% of services will only be taxed. REITs, I think there's at least one REIT in India which is from Singapore. They have been given a pass-through for rental income, and capital gains have been capped at 12.5%. Earlier, if you sold any securities, you were treated as a business income, now it's treated as a capital gain. And then for alternate investment funds, also the similar clarification has been done. And for sovereign wealth funds, if any of you are with Temasek or GIC, you get extension for another 5 years. I think the most critical thing is the new income tax bill which comes tomorrow. And the wish list is, and the hope is that this is the most significant change being done to the Income Tax Act, which was set up in 1961. So the wish list is that it will simplify the tax system by reducing the deductions and exemptions. Something like Singapore, we have very minimal deductions. There is also hope that India's tax rates may come to be in line with the world, so they may come down a bit to attract foreign investment. The biggest challenge in India for any person who's doing business in India, especially if you are of Indian origin, is that if you exceed 120 days in India and you have a measly income of 1.5 million, 15 lakhs is $20,000, you become a tax resident and you have to pay global tax. So that becomes a challenge. So hopefully there's going to be some simplification in that, and hope not, but they may want to increase the tax share to the GDP. It is quite low, it's under 10% now. Ease of doing business, as I said, they made FDIs for insurance easier. There is the Financial Stability and Development Council, which will evaluate all financial regulations to make it more responsive. Likewise for non-financial industry. Now they're going to set up an investment friendliness index for each state to foster competitiveness, to see which state provides more incentives, makes it easier. They have this Jan Vishwas Act, which decriminalized 1,000 provisions, another 100 legal provisions are planned under the 2.0. Gift City is becoming attractive. In fact, it's a bit of a competition to Singapore for financial sector. There's a lot of incentives given there, and mergers will be speedily approved. So in summary, I think it's a good budget to balance growth. They're doing a lot of measures for growth, to stimulate growth. This fiscal prudence, as Priyanka said, the deficit goes down from 4.8% to 4.4% next year. And a lot of social inclusivity, especially for agriculture and MSMEs. And I think the focus on simplifying tax and ease of doing business is quite welcome. And tomorrow is a big day. Thank you.
Thank you, Vivek. That was very comprehensive and very laboriously, painstakingly, yet interestingly developed. Thank you so much. So, may I now turn to Mr. Vinod Rai? Thanks.
Thank you. The best part of speaking now is that the budget has been taken care of. And as Amitendu said, laboriously done. And I had half a feeling going through it that Vivek was sometimes sitting behind the finance minister saying, "Ye karo, do this, do this, do this," and she was dutifully doing it. So he's explained it beautifully. So my job is only to explain what chatter went around the budget, you know. But I must accept the fact that the fisc, the government has stood firm on its credibility in terms of trying to reduce the fisc, even if it has been at the cost of restricting some expenditure. To that extent, the absorptive capacity of the economy on capex, for example, which was largely government expenditure on roads and railways, is getting limited. So it is necessary for government to get private sector, invest and partner with government to develop lots of other infrastructure, which is being done. Telephony, airports, ports, private sector investment is coming in, and the government hopes that if it reduces its own expenditure, probably they will be able to encourage and crowd in private investment, which was getting crowded out because government was borrowing a huge amount. But the best part of the speech this time, Vivek, was that the finance minister spoke for only 75 minutes. Normally it goes on for 120 minutes, and when she spoke for 75 minutes only, the members of parliament were very happy, you know, that the restriction period was only that much. But the channels were taken by surprise. The media channels were taken by surprise because they kind of, you know, budgeted or factored in a 2-hour speech, and then the experts would take over after that. But now the issue is that to a certain extent, staying on the path of fisc and encouraging private, the government has paid some attention, which it didn't more than you believe it, on credit rating of the sovereign. So when you are doing this, you are to a certain extent keeping an eye on it, and the government has done that to a very large extent. And as you said, this auspicious number of 11 coming down to 10 in spending, but 10 is Sachin Tendulkar's jersey number. Okay, so that to a large extent, that's also very auspicious for the country. And what has happened is, optically, they've shown that they've done a 10% increase on that 10.18 that the spending was. So they are still showing that capex is about 10% growth from what it was the previous year. But on the whole, the income tax to GDP ratio is going to be about 4% in the years to come. But the good news is that this will necessitate a huge amount of regulatory and innovative steps that will have to be taken if you are going to narrow the tax base, if you are going to, in some ways, reduce government spending. You will have to come up with innovative steps, and some of them you explain, some more I'll try and deal with. But why this tax bonanza for the middle class? And this is something which is a calculated gamble, calculated because I sincerely believe the government was forced into calculating in that sense. And this is giving, previously what a BJP government was known for is social engineering. How you get politics into social engineering. This is economic social engineering, because what they have tried to do is 21-22, that exemption limit was increased from 500,000 to 700,000. Didn't make an impact at all, because the impact was on the lower strata of the pyramid, very low strata. These people go to vote, they cast the vote largely because of the freebies which are being offered to them at the time of the election. And it's a, how they get shepherded into which party they're going to vote. That was the time when some murmurings were going on, because whether it's a political setup, whether it's a government setup, whether it's the armed forces, it is a middle class which controls 700 to 800 smartphones. And you remember Modi was making this slogan for himself, go vocal for local, he used to say. Which means for local products, start promoting local products. But this was that middle class which started making its presence felt in discussions, saying what is there in it for us from government. And that middle class was really not getting what they wanted. So it's kind of felt that last year itself there was some thinking that this exemption limit should be increased. But somehow government felt that they were on a strong trajectory, general election didn't matter. So it is this time that they were now forced to make that exemption limit go up from 700,000 or 7 lakhs to 1.2 million, as they have done now. Now, how does this work? As you rightly said, that they about 1 trillion rupees gets lost in, or how they go to make up. India, as you said, has 8 million people filing tax returns. 80 million who actually file tax returns. 30 million actually only pay tax. Now this 80 million is also going to hugely decline. That's why I said it is a calculated gamble that they have taken. So now, but how have they got around the middle class? How does this marginal benefit affect? You see, what happens is 1.2 million rupees, you're exempt. At that level, the government gives you an exemption of roughly about 60 to 75,000 rupees. But if your income exceeds 1.2 million, say 12 lakhs, so it becomes 12 lakh 10,000, let me say. Then you will not be taxed on that 12 lakh 10,000, which ordinarily would have been a tax of about 60,000 to 61,000 rupees. Your tax will be only 10,000 rupees. So at the margin, they have given a huge benefit to that class of people. So if your income becomes 12 lakh 50,000, then again you just pay that 50,000 till it becomes 12 lakh 75,000, which is this benefit to a salaried class of people. So to that extent, they have done it very nicely, and to ensure that this marginal benefit is something which the middleman or the middle class is going to definitely benefit from. So then comes the new income tax code or the income tax bill, which is they have tweaked about. And I remember in 2004, 2005, Mr. Chidambaram used to talk about having a new income tax bill, in which ease of paying tax, regulatory businesses, agencies, and the harassment would decline. That is something which the government has actually worked on, and the finance minister was at pains. Out of that 75 minutes, she spent about 8 minutes trying to explain how the middle class will be benefited by the tax benefits that they are going to bring, and also how the new income tax code or the income tax bill, which is going to be introduced soon, where the regulatory agencies, their effects will be reduced, or their deleterious effects will be reduced, and also where the ease of paying income tax, and that too faceless in the sense that you get to do everything online, is going to be hugely enhanced. To that extent, they are making that class of people feel very happy about it. So, also that a committee has been set up to look into how you can ease these things. And a demand has come up, a chorus has come up from the states after the budget was presented, that this committee should be chaired by the finance minister and should be along similar lines as the GST Council, which is an empowered body, whatever the council, so that the states and other representatives can give their suggestions. And if the finance minister is present in that committee or that council, it is empowered to the extent that these suggestions be increased, and the ease of doing business, ease of paying tax, and doing it online, etc., gets very, positively enhanced. Now, this has been, I think, in a large number of ways, why I call it economic political engineering is because two things have happened. On the one side, last year, if you all recall, the government announced the constitution of the 8th pay commission, where government employees like me get enhanced benefit, and that comes once in 10 years. It announced it well in advance. Number two, you are giving these concessions to the middle class. So you have a whole chunk of people who are very vocal and who probably did not support you politically, now coming out very much in your favor, and this has been more than amply demonstrated in the election for the Delhi Assembly, because this was something which had been eluding the Bharatiya Janata Party over the last 25 years, 27 years to be precise, their government coming into power in Delhi. And they were very desperate to get it. So they panned out to all kinds of middle income groups all across the city, or the NCR region as it's called, National Capital Region, and then try to fathom what exactly is it that is hurting this class of people who are not siding with the BJP. And that's what they are trying to remedy. So on the one side, with the announcement of the pay commission, they have been able to target all government employees and retirees. Immediately after the budget was presented, on the day next to that, the Prime Minister, as a part of his canvassing for the Delhi elections, addressed two huge rallies in an area in Delhi, those of you who are familiar, called RK Puram. RK Puram is densely populated only by government housing. So he was hitting it hard and telling them what the finance minister had announced in the parliament the previous day, that look, without saying it, you are that class of people who are going to benefit from it, and it has provided a huge amount of dividends for the party. Now, just to say, what is it that gives? And on the one hand, government has cut down supposedly their capex. On the other hand, tax revenue is going to be declined. The tax base will become smaller. How is growth going to come about? And I think that they have not explained so much in the budget, but they are going to rely upon disinvestment in a huge way. They are going to go in for privatization. They will monetize all these things. But more importantly, non-strategic government or public sector holdings are going to be targeted in a very big way to try to monetize those, to ensure that whatever shortfall that comes from revenues, they did not announce it purposely for, I think to a large extent there's an optical reason, because two simple examples I'll give you. One, where they have succeeded is privatization of Air India. But they got nothing in terms of revenue in return. The other, which they have talked about, if I remember correctly, from 2015, and they're not able to do, and I'm getting into specifics, is something called the IDBI Bank. They have been wanting to privatize it, you remember? And they have not been able to do it over the last 10 years. But now, after the Air India experience, they feel that they will be able to handle some of these non-strategic holdings of the public sector and privatize or disinvestment in them, which should be able to provide them a large chunk. Now, whether it comes within fiscal 25-26 is the challenge, because the procedures are very long drawn, and to find buyers for these non-strategic holdings is not easy. So that's where the gamble will be. So ultimately, it was a budget which was targeted at a certain strata of society. It seems to have achieved its objective. How much of economic benefit it will provide to growth in the economy is anybody's guess, because that's what I call the calculated risk. The fact remains that the government has established its credibility. It's hoping it will encourage ease of doing business to a large extent, encourage investment to come in, private investment to come in, and then let's see what kind of a platform it sets to ensure that growth actually takes place. Thank you.
Thank you so much, Mr. Rai. In fact, that was an excellent perspective. Usually, this is a perspective that we normally don't get to access in the commentary that comes up in the analysis of the budget. So that was wonderful. I would like to start off the question answers. I have 3 quick questions for 3 panelists. So, Priyanka, it's okay if I can start with you. You know, we all agree, and I think Vivek made it very clear that this is a budget which wants to support consumption and accelerate growth. Now, what I'm trying to bring in over here is a context that does this logic work in the sense that if there is income tax relief given to the middle class, does it immediately translate into high consumption? And the reason why I'm bringing this up is that if we look at the people or the individuals or the households who are going to get benefited from this are actually probably those who have a fairly large chunk of liabilities to service. In fact, what we now see, and it's beginning to become a little bit of an alarm, is the household debt in India. The household debt is almost 43% of the GDP. It's still not among the highest in the emerging markets. Brazil and other economies have much more. But it's still a fairly sizable amount. So, are we going to see a situation where this income tax relief, and in whatever respect that comes, is actually going to go into taking care of the existing liabilities and their servicing rather than translating to consumption? What's your thought on that?
Yeah, I think tricky question, thank you. So in any case, even from a macroeconomic perspective, right, it's empirically accepted that tax multipliers, the impact that a tax cut has for a similar magnitude on overall growth versus what a similar magnitude of capex increase would perhaps have, is much lesser. So it's usually the best case scenario for India empirically is 1:1. So equal magnitude of increase, but studies have also found that it's as low as just 0.3 to 0.4. So we really have to see, and as you said, the marginal propensity to consume, as we say in this context, how much they will save and how much of the additional actually goes into spending, this is hugely under debate right now. So my bias would be to say it would not be a 1-to-1 translation. We would definitely see part of it getting back also because of something that probably they're seeing in China as well. It's not like they don't have income, but they are worried about their job outlook, employment expectation, income expectations, and that by itself leads to some precautionary savings. So when in a global environment where you could, if you are in an export-oriented industry, be at risk of, let's say, a job loss or some sort of risk like that, you might not want to immediately spend everything you get and you will park some of it. So that's one point. And just the other point I would make is that at least for the higher slabs, there's also a risk a part of it gets spent outside of India. Tourism in India has picked up in a big way. It might be better news for Vivek and Mr. Rai were telling me a lot of Indians are going to Central Asia and of course Southeast Asia. So it might be better news for them than a lot of it getting spent in actually the domestic economy.
Thank you, Priyanka. Vivek, if I can come back to you on something that you mentioned in the beginning of your suggestions. And this is about the exchange rate. Now, what we are seeing, and it's a bit puzzling that when we look at, let's say, for example, the India-Singapore exchange rate, which is right now trading at just over 64. That is 1 Singapore dollar to Indian rupee. And the Indian rupee vis-a-vis the American dollar is nearly 87, might have reached the mark, gone above 87 as well. Now, if we look at this in the context of the fact that the market capitalization is yet to come back to where it was 7 months ago, the portfolio outflow remains not at the level at which it was happening, but there's still no net FII investment. On top of that, we see tariffs coming in. So from an Indian exporter's perspective, the American dollar is expensive. It is not easy to pick up American dollars for invoicing them as an Indian exporter, wherever it is sending to. And it's not a question of bilateral tariffs. There are tariffs that are coming up on everything, even on the products that Indian exporters are buying from other economies, maybe from Vietnam or maybe from other places, are going to get big tariffs. So as an Indian exporter, this is a very challenging time. Do you think this in some way is impacting the way businesses will look at India now? Because local businesses feel that if now I go to India and expand my operations, then exporting from India is a fairly challenging task because one doesn't know what's going to happen to the exchange rate down the line. Do you think this might be a factor that might influence decisions?
So I think this weakening of the Indian rupee, if we look at it in context of global currencies, even Singapore dollar, all currencies have been depreciating against the US because of high inflation, higher interest rates, less likelihood of short-term interest rates going down. So in fact, the Indian rupee has done better than the Sing dollar, depending on which period you look at over the last few months. And India structurally has a good position because it has current account, it has foreign exchange reserves of about 640 billion. The current account deficit, which was always a challenge, has now gone down to 1.2% of GDP. Thirdly, I think there is a lot of focus on exports. I mean, iPhones we all talk about, a lot of components are imported, but that's also a net value add. And there is a lot of foreign direct investment and foreign portfolio investment, which affects the rupee. So FDI is at 55 billion for 8 months, which is a lot of money coming in. A lot of it is private equity money, not real manufacturing. But FPI is where the challenge is. So the short-term movements that we see in the rupee is largely caused because the stock market has gone down. Indian earnings were not very good, partly because consumption was weak. So as a result, a lot of the foreign players have withdrawn their money and taken it overseas, which has also affected the rupee and the stock exchange. So I think it's a temporary issue as far as FPI is concerned, but structurally, because the US dollar is strong, all currencies in the world are declining. The Swiss franc has also weakened from 89 cents to the US to about 92, so 5% reduction in the past few years. They cut interest rates. So it's a global phenomenon that rates are going up. But in the context of tariff, I mean, China has done this aggressively. They know there were tariffs going to come of 10%. And the yuan has at the same time also weakened. So partly it's to meet your export competitiveness that this has been done, which should help the Indian exporters also if the rupee depreciates. So I think it's a competitive devaluation that's happening also in part. And I think, I'm not an expert on this, but maybe the RBI could have intervened more, but it's not doing so because you need to be relatively competitive in terms of the exchange rate and exports. So I think it may not affect it, and India is not a big exporting country. And if we have a 38 to 40 billion surplus with the US, China has a 300 billion surplus. So the export issues, tariffs is not as big an issue for India as for the country.
Thank you for your thoughts on that, Vivek. And if I could come to Mr. Rai also, I'm just exploring this thought a little further on the middle class as a political constituency, and the fact that this is for the first time the budget has, in a very unabashed manner, addressed the middle class's requirements. I'm just thinking that if this becomes a political trend, what will the state governments do? Because the central government has the lever of cutting income taxes and giving consumption flexibility, more purchasing power. what can the state governments do to impact the sentiments of the middle class? Do they have any such opportunities available?
You're absolutely right, because this is, just like every budget, freebies become a competition. Now between the central government and the state government also, this is going to become an issue, and that's exactly why I mentioned that they want to constitute that council to be a council in which the state governments are also adequately represented. To the extent that, issues which are non-financial or which do not hit their fisc come up and become attractions for the people living in the states and working in the states. See, what was happening was, government was giving free food for about 800 million people till October last year. That was again addressing the lowest rung of the pyramid. They gave NREGA benefits, the Rural Employment Guarantee benefits, which also was not adding so much to the disposable income. But the marginal propensity to consume of this middle class is slightly higher. This is a class which, as per BJP standards or BJP understanding, is a credit card carrying class of people. So they spend through that. That's why I call it the social engineering that these people have been doing. So they are hoping on that. But the state governments now soon, some of the state governments, what they've done is, they've said the pay commission will not be decadal, it will be once in 5 years. BJP states have no option but to follow the central trend, so they said, okay, 10 years, whatever the central government pay commission says, we'll try and make it applicable to the states also. But some other states like West Bengal and Kerala have been competing and they want to do it for 5 years. So if they will look for newer innovations by which they can attract their middle income class, because that middle income class, as I said, is 800 million people carrying smartphones and becoming vocal and WhatsApping to each other about the benefits or the otherwise benefits. But all said and done, if BJP has to follow its objective of turning the entire country saffron, this is the best way they can do it.
Yeah. I think you hit on a very important point, and this is probably one of the biggest concerns in India, is the state government's behavior with elections. The welfareism that's being talked about is costing a huge amount of money to the state government's budgets. This is happening, and this is possibly one of the reasons also why there's a lot of subsidies given for agriculture, small businessmen, loans, freebies, is because the government realized in the last national election that they had not got the majority they were hoping for. They need to put a lot of money for welfareism, and that is one of the reasons why the infrastructure spend has come down. So I think that's a challenge. The risk is, if this goes overboard, you may end up the Brazil way, where you go into hyperinflation, huge deficits, currency debasement. That risk is there, and I hope that eventually sense prevails on that. But the opposition is going all out. In fact, the jokes that you hear is that a woman who lives in Karnataka in one village calls her brother and says that I've made some fresh dessert and I want to give it to you. But he said, you live 100 kilometers away. I said, as a woman, she said, as a woman I get free transport, so I'll come and give you this and then come back. And what that means is that every freebie that's given, the paying passengers are paying more for it. And the same thing is happening with electricity. 200 to 300 units given free. But who's paying for it? The industrial people are paying for it. That increases the cost of doing business. And that, I think, is a challenge that the Indian government, that's a sad part about politics, but democracy, but that's a challenge.
Thank you, Vivek. And maybe questions now from the floor? We still have around 15 minutes to go. Yeah, Roger, please.
Vivek, one of those realizations of the central government was that this freebie culture cannot continue forever. So in the Delhi election, nothing has been proposed. It was all development associated issues that they went for, saying infrastructure, we build the Jamuna, we clean up, we will provide better Ayushman Bharat kind of facilities for health, etc., they totally abjured getting into the free which seems to be a healthy trend, hopefully.
Yeah, I have a quick question for any one of the panelists. There's been a lot of talk about the middle class. Do we still have a good sense of what the size of the Indian middle class is? I recall, I'm not an economist, but there's been a lot of debate about the actual size of the Indian middle class and the numbers really. And at a time when the numbers are at a premium in India for various reasons, statistics, we sort of shed light on what actually the middle class size is and also related how that kind of plays into also elections and voting.
I can have a quick start. So I'm associated with a few consumer companies in India, and one of the biggest market for us is the middle class. Now the definition of middle class varies from every economist, from every consulting company. So I think I remember reading BCG saying that the middle class is 400 million. Now that 400 million means what's its spending income, right? So there's a certain definition for that. So I think it depends on the category that you're looking at, but for the basic spending, the middle class is about 400-500 million is what I saw in the report.
Brenda, anything you want to add on this, Mr. Rai?
All government employees who live below the poverty line. Me included. I mean, if you look at all government employees in terms of state and center, you will probably reach that 450 million.
So it's bigger than that.
And all the retired employees, right?
No, I said it. Government employees,
And
retired of course.
Generous pensions.
So that is a very clear indication of what the middle class would be.
Now the middle class is the most squeezed in this economy, in this environment because of high inflation, and this is a world over phenomenon. Now what you look at the typical triangle-shaped, pyramid-shaped structure of the economy, where the rich are at the top and the bottom is the poor, and you have the middle class. That pyramid in India is changing to an hourglass from a growth point of view. So it's become more curved, which means the top end is growing very fast. The middle class is getting squeezed, so they're down trading. So the bottom of the pyramid, the spending is increasing a lot more, and the middle segment is highly squeezed. So that's a challenge that I think not only India, all countries in the world are facing. That premium is growing, the rich are spending a lot, and the poor are spending on the basics. The middle class is also moving down trading a lot. So the middle class is squeezed. I think that's what you get a sense from the economy.
Thank you. Yeah, more questions, please. Yeah.
Thank you so much for an excellent presentation and now I understand the budget much better. I have a question for all three, but particularly for Mr. Rai because of your experience. And it's more fundamental about budget. What do you think in your experience is the level of implementation for budget? I mean, government says these are the kind of things that they're going to do in terms of regulation, in terms of expenditure. How much of that gets done by the end of the year? And has that percentage of implementation changed over years?
I would like to believe that most of it does get implemented because as days are passing and budgets or government documents are becoming more and more transparent, it is coming out, as especially this government has believed in the fact of the last 10 years, that they are transparently putting out in their own figures what has been the extent of expenditure or revenue collection. To that extent, I would believe that most of it is being implemented, because even if it is not being implemented, there are analysts or economists and others who are putting it out in the public domain to, whatever. So I just mentioned, just by chance, that disinvestment or privatization, if you want it, was woefully lagging in implementation. Barely 30%, 35%, and budgets that my generation created, we would hike up that figure to show that revenue and expenditure balancing, but not be able to catch up. or implement that, But now it is happening, and to that extent, these figures are now being scaled down to ensure a greater degree of credibility in government budgetary documents.
Can I just add to what you said? I think all budgets now in India, like whenever they're presented, they come with something called an outcome budget, which is an analysis of the outlays of the previous year and what has been the outcome of those outlays. I'm not saying that it's absolutely authentic on ground, because this is basically an estimate on paper in terms of what has gone to which expenditure head, which ministry department. But that still gives an idea about which departments have been more successful in using the funds allotted to them and which departments have been less successful. So I think typically departments like the rural development and health are kind of up there and they fall short of their requirements as opposed to certain others. We still have around 5-6 minutes to go. Any other questions? Yeah, please. If you could please introduce yourself, if you don't mind. Yeah.
Shantanu Shukla from State Bank of India here in Singapore. So we had some comments regarding the fiscal consolidation and how, the timing of this tax cuts may not gel very well with the rating agencies, for example, at a time when India is looking for an upgrade. Because as Mr. Rai also mentioned, some of the disinvestment projects have not seen light of day, or they have not gone as per the plan of the government. And given that we are having a lower tax revenue collection base, there's no upside that we can see, because in fact we are talking about the RBI Forex, the revenues that the country has. In fact, we were at 704 billion at the peak last year, so we are down 60 billion. And I know it's conjecture, but some of it has gone to defend the rupee as well. So in a scenario, in a macroeconomic scenario where we will have the tariffs, etc., and the currency manipulator tag might also be there at some point. So given all that, was it a good timing to have this, tax relief given at this juncture? Is what I.
Thank you so much. In fact, I actually, before I give this question back to the panelists, I think there's a very important shape to the question that you asked, in that there's been a lot of speculation on how the tariffs being put in by Trump 2.0 are going to affect various economies and businesses in Asia. I think the biggest challenge is yet to come. The biggest challenge is going to come from the fact that there's already an identification of, quote-unquote manipulators of currency. And all the Asian economies that we have in sight are actually figuring on that list, including Singapore. So there's a lot more hint that these economies should expect to come in from the administration, because currency manipulation is actually something which is going to require a regulatory overhaul if that is going to be accepted and responded to. Unlike tariffs, because tariffs can be settled across the table. That's the Trump administration's approach. Currency manipulation is a very different story, because that's being taken as an attack on the dollar, and de-dollarization is not acceptable. So that's the context. I think it's a very important question which needs to be looked at. So, Priyanka, would you like to start with your thoughts?
I want to pick up on the sovereign rating issue. So Moody's obviously came out and said that this is not the right time. What I want to say is that for the rating agencies, what they do look at is the general government debt, right? It's for India sits at above 80% at this point of time, and for similarly rated peers and the rating upgrade that we want, it's around 60% or so. So we are way above that. What gets your public debt out of GDP down is either fiscal consolidation or higher growth. There are two parts to it. And if you followed the medium-term framework announcement that came in, the fiscal anchor has been shifted from a deficit target to a debt target. So now the central government debt is targeted to come down to around 50% of GDP by fiscal year 31. So they have bought themselves a bit of space so that, if growth does better, so if nominal growth is higher than 10%, let's say if it's 11%, they can go slower on the fiscal consolidation, and I think this allowed them to go through a tax cut in that environment. But the challenge clearly is, and here I come back to what I said in my opening remarks as well, that they're slowing down on capex and important spending on health and education, which matters for human capital development, will actually fuel your longer term growth. So there's clearly a balancing act here because the quality of fiscal consolidation matters, and hopefully, as Mr. Rai says, maybe they dial down on the welfare spending and the future budgets are more focused in fostering long-term growth. Because if growth slips from 10% to 9%, let's say on the nominal front, that means you have to consolidate that much more to reach that 50% target. So it's the debt level which really becomes important as you move out on the longer horizon.
I think Priyanka has said it very well. I just wanted to say that the fact that they are reducing the fiscal deficit from 4.9 to 4.8 this year and from 4.8 to 4.4 next year is also something that's positive from a ratings point. Or at least it's not a negative.
Yeah, I mean, he's from State Bank of India, so he's the custodian of my meager earnings, so I better be upfront with him. See, good economics always gets trumped by good politics. Okay, and this time I'm playing on the word Trump. Okay, so and the finance ministers had very little flexibility to play around with. This was the time. That's why I said that there is a very sincere political objective to this budget, and that objective has been fulfilled. So yes, timing wise, but all that they tried to show was, look, we are sovereign rating, we are keeping it in. The government does not believe it. I mean, they will never talk about sovereign rating. They say, well, our fundamentals are strong, rating agencies don't look at us properly, rating agencies don't look at our fundamentals. Rating agencies are very suspicious of government figures. And that's the fact of the matter. So all that they are trying to do is that they will balance, as he said, 4.8 will be brought down to 4.4, and they have stayed within their target. 4.9, they have kept it at 4.8. 4.5, which is for next year, they will try to keep it at 4.4. So to that extent, they are building up what I'd say a narrative which says that yes, hopefully rating agencies will also see the upside of what we are planning.
Thank you. Any last questions that are there from the floor? Yeah, please.
I'm Dinesh here. We talk about budget and project that 1 lakh crore will go for reduction in the tax, like increasing the limit to 12 lakhs. But if you see the other side, there is a GST. When they implemented, they were estimated X amount and they exceeded that. And last 2 years, that is exceeding much more than their expectation of the government. So why don't we see that the reduction in the income tax is compensated with the GST increase which the government is getting on a year-on-year? Secondly, by reducing this, increasing the tax slab and reducing the number of taxpayers, they are reducing the administrative work of most of the government departments. Because there is almost like more than 50% of the people will go out of the tax slab, and that reduces the 50% work to the income tax department. So these two aspects has never been analyzed. That one is the GST increase, they are talking about increase, but they are never saying about the compensating with what. They are just compensating with the expenditure. So here, means this is my thought, I just want panelist view on this two subjects. One is the cost reduction by the government on administrative side, and secondly about the GST compensation with the income tax. Thank you.
So very quick responses, maybe Mr. Raisa from you, and then
GST has done well, no doubt about it, and to a large extent, it has helped the the revenue deficit which the government was facing. GST has exceeded 2.10
Yeah.
lakh crores if I remember the last. So it will make up to a large extent. Income tax, expenditure on the administrative things, most of it is going online. So to a very large extent that is being taken care of. You know? So yes, these are hidden benefits, but they don't want to talk too much about GST. They'll have to share it with the states in any case. You know? So that's why they are now relying so much more on cess, which they don't have to share. That's
So just very quickly, from a budget math perspective, it's on a different line item. So GST increase is already there, but they also have a direct tax increase budgeted despite the 1 trillion loss. That's where the question mark comes in. That will you widen your tax base enough? What they are basically thinking is that because now the tax slabs are moved, maybe more people are willing to pay taxes and with simplification coming in with the income tax code maybe. So I think that's the question mark.
When you talk of GST, I get reminded of only one thing. If you buy popcorn, it's 6%. If you buy caramelized popcorn, which has sugar, then it's 18%. So if you're diabetic, you're in a good space, but if you like sugar, you pay more tax. Sorry for that.
And also in the movie halls, you mostly get caramelized restaurants. Whether that impacts going to movie theaters or not is another question. But I think on that very happily speculative note, we can end today's discussion. I would really want to thank our three panelists. Thank you so much for contributing very valuable insights. I think we will all be looking forward to how this budget unfolds in this year, which promises to be exciting, not only in a pleasant sense, but I think there are many excitements and surprises on the way. So let me thank all of you on the behalf of ISAS and SICCI, and we look forward to staying in touch with you. Thank you so much.